One of the most exciting brands in the world might be a potential opportunity, but is it really a deal or is it all hype? Let's break it down and reveal what we'd actually pay to own it, because this stock is up 155% this year alone. Now, with that said, we're not here to chase hype. We're not meme stock bandwagoners, and we're not on Reddit doing all the speculation and masking it as investing. We're here to look at real companies, real cash flow, and real opportunities. And this one might be very interesting. It's a health tech stock disruptor, quietly scaling telehealth with a subscription model, real revenue, and real growth. Now, year to date, it's up 155%. But when you see the chart, it's got a lot of volatility, up and down, massive amount of money from the start of the year. The market is reacting to every news story, but we're asking the only question that matters: is this stock selling at a fair price? So, what's a fair price? Well, let me ask you this. Would you pay $60 for a $100 bill? Of course you would. That's value investing. The goal is to get more than you're paying for. Great companies go on sale all the time, not because they're bad businesses, but because the market is emotional, the market is impatient, or the market is just plain wrong. Warren Buffett says this time and again: price is what you pay, value is what you get. And our goal as value investors is to pay less than the value we're getting. That's the game. Ignoring all the other noise, you look at the business. Does it make money? Is it growing? Does it have real value? If the answer is yes, and the price is right, you pounce on this. Buffett did not get rich chasing hype. He got rich buying great companies when no one else was paying attention. This isn't about gambling on the next hot trend. It's about buying $1 for a lot less and being patient, enough to let the world catch up to what you already saw. That's how true wealth is built, one undervalued stock at a time. Now, this company is at all-time highs, but it's a young business. So it's in the early stages with a lot of runway left. And you've got to remember, it's very, very logical that a company with a lot of growth potential could still be an undervalued stock. People are always saying value versus growth. No, value can be growth, and growth can be value. It's all about figuring out what the future looks like. So the stock today is Hims & Hers Health, ticker symbol of HIMS. Hims is disrupting healthcare in the new way. They solve real-world problems with real-world solutions. This telehealth company is scaling super fast. Its subscription model drives 85% retention after 2 years. Guys, that is insanely sticky. They're expanding into mental health, dermatology, and the GLP-1 weight loss, which has incredibly high margins and efficient customer acquisition. This is a customer-first business with predictable cash flow and serious acquisition potential. The only question now is it selling below intrinsic value? So let's dive into the numbers and find out right now. Look at this chart year to date. This is a lot of volatility. Started the year on 25, went up to 70, went back down to 30, went back up to 7. I mean, this thing is all over the board. Now, typically, for a value investor, we don't see this kind of volatility in a company, but it's a young company with a lot of growth and growing tremendously. So a lot of people are going to change their views on this as time goes on. Now, some great metrics we have here. The market cap is $15.8 billion. What that means is if you wanted to buy every stock they have outstanding and own 100% of the shares, you'd spend $15.8 billion if you could magically do it like that. Now, enterprise value here is about the same. So what does this mean? If these are pretty close to each other, that essentially means there's essentially zero debt on the business. Guys, zero debt on the business is fabulous. It allows companies like this that are young and growing to stay in business if they hit a hurdle. Now, when I first heard about people saying this is a tech business, I thought to myself, really? Is this like Tesla with the whole tech business thing, but all their money comes from prescriptions? Yeah, I get it. They're doing telehealth. But I will say this gross margin's insane. 77%. These are tech gross margins. I don't necessarily believe it's tech yet, but these are tech gross margins. Guys, in the last 3 years, their revenue growth rate was 77%. In the last 5 years, 100% per year. That's insane. But this company was only started in 2017. So it actually makes a lot of sense that would happen. And guys, another thing I love, free cash flow is much bigger than net income. Their free cash flow last year was $236 million. 5-year free cash flow is 44. Now, you see this price to free cash flow here of 66. That's a really high number. The market average is 15 to 16. But this is a fast-growing business. This deserves a premium. If you told me for the next 20 years that this company would grow 100% a year for the next 20 years, this is a bargain, an absolute bargain. And that's what we got to remember, that just because something seems expensive does not make it expensive. Now, if this feels overwhelming, guys, you're not alone. We're here to simplify all of this. Let me continue on here. Let's look at the 8 pillars. Now, Mo, why don't you chime in here on these 8 pillars?
Oh boy.
This is the one I hate.
That's the one I don't like, yes. And yeah, you're just getting a smaller piece of the pie every year.
So guys, what this means is they're diluting shareholders. They're sitting there and adding more shares. There's 2 ways to raise money when a business is growing or losing money. It's through debt, which means you borrow a lot of money, or 2, through equity, which means you issue a lot of shares. They clearly have chosen the issuing of shares.
And it's still going up.
It's still going up?
Yeah.
Why don't you show us here?
So here you can see at the bottom of my screen, you can see in 2019, they started with just under 35 million shares.
And now?
Now they're at basically 222 million. And you can see, like, in 2023, it was 209 million. So they're still diluting you. They're still issuing shares every year.
Now, that obviously the issuing of shares has decreased. But you've got to remember this. They are generating cash flow now.
Yeah, that's true.
So that's good. If you're generating cash flow and they can grow off this cash flow, okay, maybe they're going to issue less and less shares. But you cannot ignore this metric. You've got to understand what their needs are here. Mm-hmm. Because at the end of the day, guys, if you buy the stock today and let's say they double the number of shares in the next 5 years, you own half of the business you owned before. As the example, if a company has 10 shares outstanding and you own 1, you own 10% of the business. If they double their shares, not a stock split, they actually sell 10 more shares out there. Now there's 20 shares, but you still own 1. Now you own 5% of the business. So you were a good shareholder, you sat there, you were patient, and how did they reward you? By cutting your ownership in half. That's something that a lot of people overlook. It's a silent killer in investing. Now, like I said, this can feel overwhelming. But guess what? I have an absolutely free PDF that you can download that'll explain all of these key metrics to give you a strong foundation and help you level up your investing. Guys, remember, whether you're a beginner or an advanced investor, this is an important thing to understand because if you're interested in watching more videos, which all of our stats say that people watch our videos and keep watching more, we gotta be speaking the same language no matter where you are in your level of investing. And the best part is if you're new, this will do a great job of explaining all these metrics to you so you can have a great foundation at your fingertips no matter what. And at some point, you can impress all your friends when you start talking about return on invested capital and dividend yield. It's a nice, cocky way to do it. Now, we're going to get to the price we're going to pay for this company. But I really want to go through one thing here that's really interesting. Now, Mo, analyst estimates.
This is going to be interesting.
So guys, analyst jobs there are to be out there and analyze the company, talk to people in the company, understand where they're going. But as you can tell, there aren't many years going forward.
No.
It's a new business.
A lot of uncertainty.
A lot of uncertainty. But look at this growth rate, Mo. 24% earnings per share growth, 43%, 33%. That's a lot of growth rate on the earnings per share. And for revenue, 60, 20, 20, 15, 15. I'll be honest with you, I thought this was going to be higher.
I thought this was going to be higher. 100%.
I actually thought this was going to be higher.
I pulled this up and I went, that seems low.
Now, what's interesting though is, do you see a lot of commercials for HIMS?
Yes.
And I get a lot of ads on Instagram and Facebook, tons of these things. So they're doing a great job getting out there. And I'm not going to lie to you, to me, I feel like it's a valid company just because of how much I see out there. And that doesn't mean it's valid.
No, it just means they do a good job marketing.
They do a great job marketing. But the way their marketing is done to me makes me feel like, okay, if I wanted to talk to these people, I would. And they seem like legit. Now, before we get into stock price, one of the great things that I like about our channel is I believe there are multiple ways to make money. I believe in looking at fundamentals and buying when undervalued. But guess what? And this might shock a lot of people out there. I also believe in charts. Just like Michael Burry used to be a trader, I believe you can make money looking at the charts, and that's why we have Mo here. He's our in-house chart expert. Mo, what is the chart, if you can find anything on this volatile chart that says about HIMS?
So I actually, because it's so volatile, I mean, you can see this thing was at above $70 in the beginning of 2025. By April, it was almost to $20. So what I would do is I would come to a 15-minute chart and I would day trade this. So each of these little segments is 15-minute period. So this is 15-minute. Why would I say this? Because you can get basically a $5 run during the day. This was Thursday, I believe. Look at this big drop from above $70 to $64 a share. Every day there's some point, and even today, there's some point where you're going to get movement. I would go and look at this from a 15-minute perspective just because I don't want to be in something like this overnight. Who knows what can happen overnight?
That is true.
That's the problem.
There's a lot of volatility here.
Yeah.
All right, so we've looked at charts, we've looked at fundamentals, we've looked at analysts, we've looked at 8 pillars. These all help us gauge a story here, make a story up. Now, how do we use that to get a stock price that works? Well, guys, that's why you have the stock analyzer tool. It allows us to take the story and the numbers and put it together. Everybody, including me in the past, always looked at the story. If the story was good, I used to buy. This was me 25 years ago. I was that average person out there that did that. When I saw that that didn't work, I figured out, okay, there's got to be a better way. And that's why I created the stock analyzer tool. I'm here to make assumptions about the future. Now, with a company like HIMS, it's difficult because we don't have a long track record. It's not like Microsoft or Google that's been around for so long that we can look at the history and say, all right, they're big, they're growing, they do this, these are their profit levels.
And when you see revenue growth of 86% in the year, it's hard to say, oh, they're going to do 86% next year.
Correct.
And the following year, and
Correct.
10 years from now.
And Mo, look at this profit margin.
Exactly.
The last 5-year average is negative. Last year was 1%. It was 9%.
Right.
There's a lot of craziness out here, but let's break it from the beginning. Now, one thing I love, this return on capital was negative over the last 5 years, positive last year. That means they're getting better.
Yep.
So what does return on capital mean? It means when they invest money into the business, they get a high return on that money. That's probably paying off with their Instagram and all these other things they're doing. You want companies like this. You want companies that can take their cash, invest it, and get really high rates of return. Those companies deserve a premium. Next, I'm doing a 10-year analysis. Mo, I put 10, 20, and 30% revenue growth for the next 10 years.
I think that's fine.
I mean, if you look at analysts,
You're higher than analysts.
for a 10-year period, you're right.
Yep.
But you see this number and you go, oh my God, they're going to crush it.
Yeah.
Guys, this is what makes investing hard, especially with young companies. Profit margin, I did 10, 20, and 30%. They did 10% last year. Free cash flow was 13%. So maybe I'm low here. I don't know.
That's the hard part.
But this is where people in our community who've probably read the 10K can probably help you out there. If you're in our community, can probably go in there and say, hey, what are you guys seeing for potential profit margin? Because remember, their gross margin is 77%. That means that every extra unit they sell, 77 cents of it, goes to profit before taxes and overhead. And by the way, thank you very much, Mo. The 10K is their annual report where they get so thorough. And guys, it's boring as F to read.
Very long, very thorough.
Mo and I have read 10Ks before and we snooze. I look for information in the 10K, but guess what? With the thousands of people in our community, I guarantee somebody has read it.
Every word.
Every
word.
Not me.
No.
I look for information. I try to find out, hey, what's their overhead like? I want to go look at it and say, okay, so if they quadrupled their sales, what would their bottom line profit be? Because look at Microsoft. Microsoft gross profit is 68%, which is less than 77%. And their bottom line is 30 to 34%. So maybe I am being too conservative on this.
Maybe.
I could be, because they have a higher gross margin than Microsoft. So it's not unreasonable to say they might have a higher profit margin than Microsoft. But these are the issues this is what makes investing an art.
And the more information you have. I mean, in 2 years, you won't look like this because you'll have more information.
Yes.
It'll be easier to make assumptions.
But of course, we all have FOMO. We want to get in early.
Now.
But we got to sit there. So I'm actually going to do something different, Mo.
Okay.
I'm going to sit here and say 15, 25, and 35%.
Okay.
Because I do think that they should be able to make 25% if it's a lot of telehealth and a lot of prescriptions and fees for
High
that.
margin stuff.
Okay. Now, next questions. What PE would I assign to this company 10 years from now? What price to free cash flow? If they keep increasing this ROIC and the market average is 15 or 16 for a PE, I got to go higher than that. I put 16, 19, and 22.
Okay.
And finally, desired return, 9%. Guys, this desired return is purely the market return. That's it. What's the value of this business? What's that intrinsic value? I do not buy any company for a 9% return. Why? Because if I want a 9% return, I'll just buy a low-cost ETF. So you got to have a higher margin of safety. You do that by increasing your desired return. How high? Depends on every single company. If you think you know this company inside and out, you're comfortable with it, your return requirements can be lower than somebody who might be like, listen, there's a lot of shakiness out there.
Yeah.
For me and a company like Hims, I'd want a much higher desired return because of how young it is, because of how competitive the market's getting. And I look at people like Amazon.
Oh. Amazon could take this out.
Well, they already have telehealth.
Yeah.
I mean, they have a great, Amazon has a great advertisement. They have somebody, I think it's a woman on an airplane doing telehealth.
Right.
And I'm like, oh my God, what a great ad.
Yeah.
Because all I thought to myself was, that basically tells me, it doesn't matter where you are, you're going to get them.
Yep.
And to me, would I rather go to Amazon or Hims for telehealth?
I'd probably go to Amazon.
I would too.
It's just they have that reputability. I don't need to figure out the reputability of Amazon. I need to figure out the reputability of this.
Correct. But the other part is Cleveland Clinic has telehealth.
That's true.
So I go to Cleveland Clinic for telehealth versus Amazon.
Right.
Why? Because we live in Northeast Ohio, and Cleveland Clinic's right down the street from us, and it's the number 2, supposedly, hospital in the world.
I saw that.
Now, guys, so far, I love the story of the stock, but the price has to make sense. And like I said before, 20, 25 years ago, I was chasing hot stocks. I was following tips. I was getting caught up in the hype, hoping something would stick. But guys, that's not investing. That's gambling. That's exactly why I created Everything Money. I wanted to give 25 years ago, Paul, the tool, strategy, and community that I never had. So when you join EM, you're not just getting our powerful investing software and our famous stock analyzer. Guys, we have tons of other tools on here I haven't even covered yet. But most importantly, you're getting this strong foundation I talked about before. We integrate you into the community by having you watch courses, hundreds of videos available for you to be able to learn. We want to all have the same foundation, and we want to get you engaged into our community of like-minded investors who all want to level up their investing no matter where they're at. We have beginner investors and we have absolute experts in there. It doesn't matter. There's a place for everybody in there. And guys, even more exciting, we're about to add the brokerage to the platform. Now, this isn't our brokerage. All it does is it allows people to connect their famous brokerages like Schwab, Robinhood, Webull, all these places into our software so they can make the trades as they do the research. This is going to make it even easier for you to level up your investing game all in one place. But let me be very clear about one thing. This is not for people that want to chase the next shiny object. If you're looking for me to hand you fish, or people in this community just hand you fish, you're in the wrong spot. If you're not ready to follow a process, stick with it, put in the work, don't sign up. Guys, I have almost 30 years of experience in investing, and I'm still learning all the time. If you're committed to investing, no matter what level you're at, you need to start our 7-day trial. Click the link below. We have limited spots each day, and we don't know how long we're going to keep the trial open because we're having internal conversations about making this application only. Now, it doesn't mean if you have a lot of money, you get in. Quite the opposite. What it means is, do you have a desire to learn and get better? So if you're that serious investor, this is the time for you. This is the software for you. So click the link below, sign up for the 7-day trial. And there's a reason why you will see that 83% of people who sign up for the trial end up buying the software. So Mo, I'm going to hit the analyze button. Okay. The stock's currently at $65 per share.
This is going to be interesting.
Wow. A low price of 30, a high price of 385, a middle price of 117. I was not expecting this.
Neither was I.
I will say one thing. This current price shows a 16.5% return potential, but does not include any dilution from Hims issuing more shares.
True.
So guys, if you thought Hims was interesting, wait until you see this. I picked my own 7 stocks using the same value first strategy we just talked about. I made my own Magnificent 7, and I'm putting them against the actual Magnificent 7. And as of the end of July, my Magnificent Seven were winning. It's shocked me, and it's too short of a window to declare victory. But click the video on your screen to see which stocks made the list and why I think they'll keep on winning versus the other Magnificent Seven for years to come. Thank you for your time.